Before we move on further with FAR-5, let's take a step back and recap on all that we've learned till now on financial accounting and reporting. So in FAR-1, I gave you the income statement and the balance sheet. We talked about all the items of the income statement, looked at a few miscellaneous stuff, accounting basics, concepts. Then when we got to FAR-2, that's when we got started with looking at the balance sheet items. So in FAR-2, we looked at current assets and current liabilities. Then we moved on, FAR-3, that was investments. So investments could be current assets or non-current assets. We also looked at PP&E, property, plant and equipment, non-current assets. We looked at intangibles, patents, copyrights, goodwill, non-current assets. Then in FAR-4, we looked at present value concepts. There we talked about bonds payable, non-current liabilities. So FAR-3, it was investment in bonds. So as an investor, FAR-4, it was an issuer of bonds, bonds payable, non-current liability. In FAR-4, we also talked about leases. Now, we had leased asset and leased liabilities in case of capital leases in the books of the lessee. So you could have a lease liability here, lease asset here. We talked about pensions. So we had pension assets and pension liabilities. So if it was an overfunded pension plan, asset. Underfunded, liability. Then we started with FAR-5 and we looked at deferred tax items. So we could have deferred tax assets or liabilities, and they could be current or non-current. So you could have a current deferred tax asset or liability, as well as a non-current deferred tax asset or liability. Now, in this section, we're going to focus on the stockholders' equity section of the balance sheet. We can also look at the balance sheet in a different way. We can look at it as sources and uses of funds. So why does this business entity need funds? They need funds for the working capital, the current assets minus current liabilities, and to buy fixed assets, non-current assets. How do they get those funds? What are the sources of those funds? They could borrow funds, debt, or they could take in funds from owners' equity. So that's about stockholders' equity, and that's why we have stockholders' equity after liabilities on the balance sheet. Think about it. If a business is closed down or liquidated, then they're going to sell all the assets, get in cash, use that cash to first pay off the current liabilities, then pay the bondholders, the debt, non-current liabilities, and whatever remains goes to the owners, stockholders' equity. So now, with this perspective, let's get started with looking at the most important component of stockholders' equity, common stock. So we'll look at common stock, and I have common stock on my board as well here. Now, common stock that the entity issues to common stockholders, the owners, could have a par value or stated value. So that could be as per the company's certificate of incorporation. That could be the dollar number printed on the stock. Now, when the company issues common stock to its stockholders, they get in cash. So the journal entry for issuance of common stock would be cash coming in and common stock would be credited. So if it's a $10 common stock at par or stated value and they get in 10 cash, this is 10 debit and 10 credit. But what if they're issuing this common stock in excess of par? The printed value, that's 10, but they're issuing it for 15. They're issuing it in excess of par, and that creates another account here called additional paid in capital or APIC. So if this is issued for 15, cash comes in, not 10 but 15, and you have another account here which you call APIC, and we'll call it APIC common stock because this additional paid in capital is due to, it's related to common stock. Now, there could also be times when companies taking in stock subscriptions from potential stockholders for new offerings of stock. So in that case, the subscribers, they give a down payment to the company at the time of subscription. The balance they would pay when the stock is issued, and this creates common stock subscribed. So let's say for this stock, which is at $10 par, issued at $15, is subscribed, and at subscription the subscribers paid a $2 down payment. So let's look at subscriptions. So instead of getting all the $15 in cash right away, they just got $2. So cash came in not 15 but just 2. How about the remaining 13? That was receivable. So you have subscription receivable. And that would be 13. Now, instead of creating common stock, because common stock is not yet issued, it's just subscribed. So you have another account. Instead of common stock, you have common stock subscribed. And that's again at par $10 and in excess of par, so that's APIC common stock 5. Now later the subscribers are going to give back the remaining 13. They've just paid 2 now. They're yet to pay 13. When they give back 13, cash comes in. So cash to subscriptions receivable. So the remaining cash 13 will be coming in. So guys, this goes off. This is a wash now. So they got 2 first, they got 13 later. But now the company has issued out the common stock. So it's no longer common stock subscribed, it's the actual common stock. So we will debit common stock subscribed. So we had created this account for the time being. Now we'll debit it. And we'll credit common stock. So this account which is created here goes off here. Now, if you combine these 3 journal entries, the resultant journal entry would be this one. So in this case, we got all the cash at once. Here we got cash in 2 pieces. First we got $2, then we got the remaining $13. So that was for the issuance of common stock. Now there might be times when the company wants to repurchase and retire their common stock. They no longer want that equity to be outstanding. Guys, for repurchase and not yet retired, we're going to talk about treasury stock in a moment. But now what we're saying is the company is repurchased and immediately retired. So it's no longer issued and outstanding. So in that case, let's look at the journal entries. So if the stock is retired, this common stock which is issued and outstanding is no longer issued and outstanding. So it's credit here. When it's retired, you need to debit it. APIC common stock that was there on issuance, that needs to be reversed now. So you have APIC common stock. And in this case, cash came in. When you're retiring, cash needs to go out. So cash would be credit. Now let us say they had issued the stock at $15. Now when they're retiring it, they're buying it back. They are getting their own stock, the same stock, not for $15 but for $12. So in that case, the cash that's going to go out is only 12. But common stock at par, that was 10. APIC common stock, that was 5. Now look at this. We've got 15 on the debit here, but just 12 on the credit. This means we need a credit plug. And that credit plug for retirement of stock is APIC retired stock. So guys, I gave you APIC common stock here. Now we're talking about APIC retired stock. This would be 3. So guys, under APIC, you could have APIC for common stock, APIC for retired stock as well. Now that was when you purchased it lesser than the issue price. How about you paid more than the issue price? So you issued the stock for $15. Now when you go back and buy it to retire the stock, you pay $16 more than the issue price. Apply the same logic here. Cash goes out 16. Common stock at par, that's 10. APIC common stock on issuance, that was 5. Now in this case, we don't need a credit plug, we need a debit plug. Now your debit plug again would be APIC retired stock. So it could either be a credit or a debit. So in this case, this would be $1. So 16 on the debit, 16 on the credit. Now, one thing that you need to remember is APIC, additional paid in capital. All the stockholders' equity accounts, they are credit accounts. For APIC, they can only have a credit balance. They cannot have a debit balance. Now, in this case, you're giving APIC retired stock a debit balance. That's okay if there is already some credit balance in there, APIC retired stock, and now we are debiting it. But if there is no balance for retired stock, then instead of debiting APIC retired stock, we would debit retained earnings. Because retained earnings, that could have a debit balance, but APIC, additional paid in capital, cannot have a debit balance. So after APIC, we're going to have retained earnings here. Retained earnings, so net income from the income statement, that flows into retained earnings. And if you remember in FAR-1, we also talked about accumulated OCI. So it was on tied and on the income statement, OC for comprehensive income. Other comprehensive income on the comprehensive income statement, that flowed into accumulated OCI on the balance sheet, and that was PACE. So we've gotten the concepts for common stock pretty well. We've looked at issuance of common stock, all the cash comes in at once. Subscriptions, cash comes in pieces. And we've also looked at retirement of common stock. Now, when you repurchase common stock and not retire it, I told you, we're going to look at treasury stock in just some time. Hold on to your seats. On page 16, we're looking at common stock, which normally has highlight par value, which is there on the certificate of incorporation, or stated value, which is assigned by board of directors. Now, when you issue common stock, we're going to get in cash. So cash is debit. The credit is to highlight common stock at par. Now, if the common stock is issued in excess of par, that goes to highlight APIC common stock excess of par. On page 17, we're looking at repurchase and retirement of common stock. Now, if the repurchase price is less than the original price, then the difference goes to highlight APIC retired stock. But if the repurchase price is more than the original price, then the difference is debited to APIC retired stock. But after APIC retired stock becomes zero, it cannot have a further debit. That's when you want to debit to retained earnings. Now let's talk about preferred stock. So that's a part of your stockholders' equity. But it's preferred over common stockholders. So let's say when a dividend is being declared, the first preference is to preferred stockholders. Then it's paid out to common stockholders. Or let's say there's a liquidation of the entity. In that case, again, preferred stockholders have a preference over common stockholders. Now, if you look at it, we got liabilities and stockholders' equity. So if a corporation is liquidated, you first clear off the current liabilities and the debt holders' non-current liabilities. Then you got to pay the preferred stockholders before you pay common stockholders. So that's the preference that we've been talking about. Now, when you issue preferred stock, it's a similar journal entry as you have here. So let's put that down there. So this is common stock. Now let's talk about preferred stock. So when you issue preferred stock, again, you're getting in cash. The credit is to preferred stock. Now, if preferred stock is issued in excess of par, again you have APIC, but instead of calling it APIC common stock, we would say it's APIC relating to preferred stock. So APIC preferred stock. So where we have APIC on the balance sheet, we have APIC for common stock. We've talked about APIC for retired stock. Let's also put in APIC preferred stock here. Now, preferred stock could also have certain additional features, optional additional features, and let's talk about that. Now, you could have cumulative preferred stock. What that means is if you don't pay dividends to your preferred stockholders this year, if it's a cumulative preferred stock, you need to pay them dividends for 2 years next year before you pay anything to the common stockholders. So let's say you don't pay them dividends for 2 years, and in the third year you got to pay cumulative preferred stockholders dividends for 3 years before you pay anything to common stockholders. So the dividend accumulates. It's a cumulative dividend for these guys. So that's an optional feature that you could have on your preferred stock to make it look more attractive. Now preferred stock, it could also be participating preferred stock. So as the name suggests, preferred stockholders which are participating preferred stock, they participate in excess dividends. So when the company is issuing out dividends, it needs to give out dividends to the preferred stockholders and then to common stockholders. Any excess dividend is then shared between these two guys. So the preferred stockholders having participating preferred stock, they participate in that excess dividend. Now you could also have convertible preferred stock. If you recall, we talked about convertible bonds. So a bondholder having a convertible bond could come back with his bond and take home a common stock of the company. Now a preferred stockholder having convertible preferred stock could come back with a preferred stock and again take home common stock. So that's convertible. It's the option of the stockholder. He can convert it into common stock. Now you could also have preferred stock with warrants. Again, we had bonds with warrants. So in that case, the bondholder could keep the bond with him, come back with the warrant, pay us some dollars and take home common stock. Same rule applies here. So preferred stockholder plus warrants. So preferred stock, he can hold it with him. He can come back with the warrants and some cash, take home common stock. Now you could also have callable preferred stock. Again guys, we had callable bonds. Now this is an option of the issuer. So the issuer who issued bonds could call back the bonds. If it's callable preferred stock, the issuer which is issued preferred stock could call back its preferred stock. Okay, so as you can see, preferred stock does have certain similarities with long-term debt bonds, but it's part of the stockholders' equity section. It's not a liability. But if the preferred stock is mandatorily redeemable, that means the entity has to redeem it, then it becomes more like debt and not equity. In that case, it's treated as a liability and not equity. So you call this sort of a preferred stock mandatorily redeemable as mezzanine. So it's like a mezzanine between liabilities and equity. But that's only if this mandatory redemption is there. Otherwise, it's part of stockholders' equity. On page 18, we're looking at preferred stock. And as the name signifies, these are preferred for highlight dividend and highlight liquidation. So the preferred stockholders, they are paid dividends before dividends are paid out to common stockholders. In case of liquidation of the corporation, the preferred stockholders have preference over common stockholders. Now looking at the journal entry to record issuance of preferred stock, that's pretty similar to the common stock issuance journal entry. Just that you have preferred stock on the credit, and if the preferred stock is issued in excess of par, it goes to APIC preferred stock. Now our focus here is put a box around optional additional features. First one, highlight cumulative. So if it's cumulative preferred stock, then the dividends not paid to the preferred stockholders in earlier years must also be paid before anything is paid out to common stockholders. So right there, pay dividend later if not paid now. Next, highlight participating. So if it's participating preferred stock, after both the preferred and the common stockholders receive a specified level of dividends, the balanced dividend distributions are shared between the participating preferred stockholders and the common stockholders in ratio of their respective par values. So right there, share the excess dividend. Now it could also be highlighted convertible preferred stock. Now in this case, the preferred stockholder has an option to come back with the preferred stock and take home common stock. So right there, stockholders option. A company could also issue highlight preferred with warrants. So in that case, the preferred stockholder could continue holding on to his preferred stock, come back with a warrant and convert it into common stock. The last one they highlight callable. Now in this case, the corporation has a right to call back issued preferred stock. So right there, issuer's option. On page 19, we got a comprehensive example on preferred stock. So Scarce Company had the following stock outstanding as of 31st December 2011, at which time $3,500 of dividends are declared and paid. Now they got 10% preferred stock with par value $100, which they had issued on 1st Jan 2009, and the book value is $5,000. They also have common stock with par value $1. Total book value of that is $15,000. Now it says no dividend has been paid by Scarce in the last 2 years, 2009 and 2010. Calculate the allocation of dividend between preferred and common stockholders, assuming that, so the first part, preferred stock is non-cumulative, non-participating. So in that case, the dividend payable to preferred stock is $5,000 par value into 10%, because that's 10% preferred stock, calculates to $500. The balance dividend is paid out to common stockholders, $3,000. The second part, now we are assuming that the preferred stock is cumulative but non-participating. So highlight cumulative. Now dividends have not been paid out in 2009 and 2010. So that's dividend in arrears for cumulative preferred stock. So $5,000 into 10% for 2 years, that's $1,000 dividend in arrears. Dividends for this year, that's $500. So we need to pay 1,000 plus 500, $1,500 to preferred stockholders before anything is paid out to common stockholders. The balance $2,000, that goes to the common stockholders. Third part, we got participating preferred stock. Highlight participating. Now in that case, first we pay out a 10% dividend to the preferred stockholders, $500. Then we calculate the same 10% for the book value of common stockholders. That calculates to $1,500. So that's $2,000 of dividend gone. What's remaining? $1,500. Now that $1,500 would again be prorated between preferred stockholders and common stockholders. So preferred stockholders, that's $5,000 book value out of $20,000 book value. Let's say 25%. So they're going to get $375 of this excess dividend. Common stockholders, they'll get the remaining 75%, remaining $1,125 of the excess dividend. So the total dividend which goes out to preferred stockholders is $500 plus $375, $875. Common stockholders, they get $1,500 plus $1,125, $2,625 of dividend. Now the fourth part, in this case, the preferred stock is both highlight cumulative and participating. So now in this case, we're going to have dividend in arrears for the cumulative preferred stock for 2 years, 2009 and 2010. So for 2009 it was 500, for 2010 another 500, $1,000 in total. For 2011 they're again going to be getting another $500. So total dividend paid out to them is $1,500. Then you have total dividend paid out to common stockholders at 10%. So $15,000 into 10%, that's again $1,500. So after this, what remains is $500, which is now going to be prorated between preferred stockholders and common stockholders. preferred stockholders, their book value is $5,000 out of a total of $20,000, 25%. So they're going to get $125 of this excess dividend. Common stockholders, they'll get the remaining $375 of this excess. So the total dividend that goes out to preferred stockholders is $1,500 that we calculated above plus $125 excess dividend, $1,625. What goes out to common stockholders is again $1,500 plus $375, $1,875. We've talked about common stock, we've looked at preferred stock, and we've also been talking about additional paid-in capital APIC. We've seen APIC due to common stock here. We've seen APIC due to preferred stock here. We've seen APIC retired stock when you retire the stock. Now, we could also have APIC for treasury stock, APIC for warrants, for stock options expired, not excised. So as you can understand, APIC could have a lot of forms, and as we move on and learn more and more about stockholders' equity, we're going to discuss all this. But for now, let's say when you're talking about stock options are generally issued to employees. When you're looking at stock warrants, that could be issued to bondholders. It could also be issued along with preferred stock. You also have something called stock rights that you issue to stockholders, which gives them the right, not the obligation, to buy more stock. Now, for stock rights that you issue to stockholders, there's no accounting entry until the stock right is actually exercised. So we're going to be looking at stock options and stock warrants as we go on. Stock rights, not a lot of focus because there's no accounting entry for that. On page 20, we got APIC or additional paid-in capital. Now, there are a lot of forms of APIC. It could be APIC common stock, preferred stock, or retired stock. We'll also talk about APIC treasury stock, APIC warrants, APIC stock options. So let's make a little note here, right? Stock options, that's generally issued to, right, employees. Right? Stock rights, that's generally for existing stockholders. Warrants, that could be issued along with bonds or preferred stock. So that's for, right, debt holders and P/S or preferred stockholders. So we've been looking at stockholders' equity on a balance sheet. We looked at common stock, preferred stock, APIC. Now let's talk about retained earnings. So the way this works is you got beginning retained earnings, and you could have some adjustments to the beginning retained earnings. Now remember, if you have a change in accounting principle, retrospective adjustment, need to adjust beginning retained earnings. If there's a prior period error, correction of an error, that calls for a prior period adjustment to beginning retained earnings. That gives you adjusted beginning retained earnings. And then we have the net income number from the income statement flowing into retained earnings. So that increases the retained earnings. Now, the board of directors, when they pay out dividends to the stockholders, that's again paid out of retained earnings. So they look at how much retained earnings do they have, and then they decide how much dividends to pay to the stockholders. So minus dividends paid out or payable, we'll talk about that. That gives us ending retained earnings, the number for retained earnings that we're going to have on our balance sheet. Now let's talk in detail about this dividends declared or paid to stockholders. So let's go on that side of my board. So we got dividends here. And whenever we're looking at dividends, we are looking at 3 dates for dividends. First date is when the dividends are declared by the board. So they announce that we're going to be paying out dividends to you stockholders. So that's the date of declaration. And on that date, you have retained earnings getting reduced. Guys, dividends, they're going to be paid out of retained earnings. So you need to reduce retained earnings. Retained earnings, that's a credit balance. That's part of equity. So to reduce retained earnings, you need to debit it. So you debit retained earnings. And dividends are not yet paid out. They're just declared. So the credit is to dividend payable liability. Then you have a second date called the record date. Now think about it. Stocks, they keep changing hands. So on every date, you have a different set of stockholders. Now whom do you pay this dividends out to? That's decided on the record date. So all the shareholders as of the record date are paid out these dividends which were declared by the board. So that's the date where no journal entry is passed. But you are looking at the stockholders of the company who will be entitled to receive this dividend. Now it's time to pay out the dividend. So dividend payment. So now dividend payable, that was a liability here. Now that goes off. It's no longer there because the dividends have been paid out. And let's say if you're looking at cash dividend, paid out in cash. So cash goes out from the company. So this one is, let's say, cash dividends. So we're looking at 3 dates. Number 1, date of declaration, where we have retained earnings getting reduced and we're creating a liability dividend payable. Second date is a record date where there's no journal entry. You're just looking at who are the shareholders as of this date. Third date, the shareholders as of this date get the payment for this dividend. Now, this was a cash dividend where cash went out. Let's say the company does not have enough cash, and instead of giving out cash, they want to give out a property. Now, generally this could happen if it's a closely held company, few stockholders. Then instead of giving out cash, they could also give out PP&E. They could give out a piece of land. So let's look at property dividends now. So number 1, when it's declared, again you have retained earnings to dividend payable. Record date, naturally no journal entry. And then the third date, payment date, you have dividend payable. And instead of cash going out, now the property goes out. Let's say the piece of land is distributed out as dividend to the stockholders. Now guys, the trick here in case of property dividend is that property needs to be given out at fair market value. So you're not looking at the book value of the property, you're looking at the fair market value when dividends are being declared. So let's say this piece of land which is being given out as dividends to the stockholders has a book value of $500. It was purchased for $500 by the company. But now the fair value is $700. So the retained earnings is going to be debited by the fair market value, that's $700 at this point. And when the dividends are being paid out, dividend payment date, the land which is going out to the stockholders, that's worth $700. Now, so far so good, but wait a minute, this land was on the books at $500. We have created it for $700. So guys, now we also need to push up this land by $200. And that's something we'll do on the declaration date itself. So on the declaration date, we'll pass a second journal entry where we'll increase the land by the required $200 because the land book value is $500, but the fair market value on the declaration date is $700. The credit would be to gain on the transfer of land or payout of land as dividends. So gain on land $200. Now guys, one more thing that you want to note here. Look at this. Retained earnings, you have debited them by $700. They've been reduced by $700, the fair market value of the land. Now this gain on land, which is a credit here, this also flows into retained earnings. This goes into your income statement, net income flows into retained earnings. So this would also go into retained earnings. So this actually increases the retained earnings, credit. So guys, what we can say is the net effect on retained earnings is 700 minus 200, 500. That was the book value of the land. So ideally what's happening on your balance sheet is, let's say the land of $500, that's going out. Retained earnings is getting affected by $500. But for the journal entries, you got to have $700, the fair market value of the land. Dividend payable, this gets washed off. Guys, whenever we're looking at dividend payable, it's a wash. Dividend payable here, this one is a wash. The land, you've increased it by 200 and then 700 when it goes out. The gain on land ultimately goes to retained earnings. So that was about property dividends, when they didn't have enough cash and they wanted to give out a property to the stockholders as dividend. Let's talk about liquidating dividend. Now I said we're going to be paying out dividends from retained earnings. So when there's a dividend being declared, it's retained earnings, debit, dividend payable, credit. But let's say the company does not have enough retained earnings and they want to give out dividends to stockholders more than what they have earned. Can they do that? If they do, that becomes a liquidating dividend. They are actually returning back the stockholders' capital back to them. And in this case, you debit APIC. So retained earnings is debited to the extent that the company has earnings. In excess of that, they're trying to liquidate. You debit APIC. Now, you cannot debit the common stock account here, because the common stock, that can be eliminated only when the corporation is dissolved. So let's look at this on the dashboard. So you have dividends, which I told you needs to go out from retained earnings. Now the company did not have enough retained earnings and they paid out dividends in excess of their retained earnings. That's when we start reducing it from APIC, liquidating dividend. Getting back there. So we looked at liquidating dividend. Now let's talk about scrip dividends. Let's say the company has earnings, but they don't have enough cash to pay out to the stockholders right now. They're expecting cash to be coming at a later date. So what they can do is they can announce, they could declare a scrip dividend where they're going to be paying out those dividends, those cash later. It's declared now, but the payment happens after a significant period of time. So that becomes a scrip dividend. So when we are looking at the first journal entry here, so this was the first journal entry here, and we're looking at the first journal entry here, declaration, you have retained earnings getting reduced, and instead of dividend payable, we'll call it scrip dividend payable. Record date, there's no journal entry. Third, the payment date. So you'll have scrip dividend payable. So instead of dividend payable, we'll call it scrip dividend payable. And you have cash going out. Now because of the time gap in here, you could also have interest being paid out on the scrip dividends. So in that case, you would debit interest here. So scrip dividend payable, debit any interest, and credit cash goes out. So guys, we've looked at cash dividends, property dividends, we've talked about liquidating dividends, we've talked about scrip dividends. Now as you can understand, all these dividends, they reduce retained earnings. Liquidating dividends also can reduce APIC. And they reduce your total stockholders' equity. Now let's look at something different. The company, they've got retained earnings, but they don't want to give out cash to stockholders, and they don't have any property, or they don't want to give out any of the properties to stockholders. Instead of that, they tell the stockholders, take more stock. That is called a stock dividend. So let's look at that. So, stock dividend, let me put it here. So what they would do is, let's say, every stockholder who owns 10 stocks gets one more stock. So that's a 10% stock dividend. Or every stockholder who owns 10 stocks gets 4 more stock, 40% stock dividend. So guys, it could be a small stock dividend, less than 20%, or it could be a large stock dividend, more than 25%. So now, when you're giving out stock dividends, when you're declaring stock dividends, What's being reduced? Retained earnings. And you have common stock distributable. So let's put it all together. So you have common stock distributable. When you actually pay out the dividends, stock dividend, then you have common stock distributable debit, and the credit would be to common stock, and there could be EPIC. So let me just combine the journal entries all together here. Now, I've given you two types of stock dividends, small and large. So if you have a small stock dividend, and I said less than 20%, let me go less than 20 to 25%. Large stock dividend, that's more than 20 to 25%. So if it's less than 20%, it's always small. If it's more than 25%, it's always large. If it's 20 to 25, you got to decide whether it's small or large. And the difference here is when it's a small stock dividend, it's at fair market value of the stock. So retained earnings that you reduce here is at fair market value. So you have common stock credited and APIC. Common stock plus APIC, this is again the fair market value of the stock, the prices at which the stock is being traded in the market. So that's when it's a small stock dividend. But when it's a large stock dividend, then we are not concerned about the fair market value of the stock. We just look at the par value. In that case, the retained earnings, that's reduced by par value. And the credit to common stock, that's again at par. So in this case, we don't need any APIC. So guys, let's say there's been a stock dividend of a stock which is at par $10, trading in the market at $15. So in case of a small stock dividend, the debit here would be 15. So you'd have 15 here and 10 common stock, 5 APIC. But in case of a large stock dividend, you're not concerned about the market value. You're just looking at the par value, 10 and 10. So that's about stock dividends. Something that you really want to know about stock dividends, something which is pretty interesting. Let's go and look at that. So stock dividends, they're reducing retained earnings. All dividends reduce retained earnings. But they are increasing your common stock and or your APIC. So retained earnings getting reduced. Common stock and or APIC, so in case it's a large stock dividend, it's only common stock. If it's a small stock dividend, it's common stock and APIC. So this one is getting reduced, common stock and APIC are getting increased. So ideally, what happens to your total stockholders' equity? That remains constant. So guys, that's the interesting part. So if you had, let's say, a cash dividend, you had dividends being declared and cash going out. So that reduced total stockholders' equity. If you had a property dividend, retained earnings getting reduced, property going out, reduced total stockholders' equity. But now, when you have a stock dividend, retained earnings, that's getting reduced, but your common stock and APIC, they are increasing. Total stockholders' equity is remaining constant. So that's something that's pretty interesting about stock dividends, and you got to know that. Now, we've talked about stock dividends. Let's also talk about stock splits. Let's say the company has 7,000 common stock issued and outstanding, and they call for a 2-for-1 stock split. What they would do is they take back those 7,000 stocks and issue 14,000 stocks. Now this calls for no journal entry. Just the number of the stocks issued and outstanding changes. There's nothing else happening here. Now guys, if you look at it, a large stock dividend is also something pretty close to a stock split, and that's why you did it at par value. Now, both stock dividend and stock split do not affect your total stockholders' equity. So that's the exception to the rule for dividends which reduce stockholders' equity. On the second half of page 20, we're looking at retained earnings and dividends. Highlight, retained earnings represent accumulated earnings. So those are earnings which are accumulated by the corporation not paid out to the stockholders as dividends. So you got beginning retained earnings plus net income for the period less dividends paid out gives you ending retained earnings. Now we're going to focus on dividends, and right there note all dividends reduce stockholders' equity except for stock dividends and stock splits. We'll now look at relevant dividend dates and put a star there because this one is very important. First you have the date of highlight declaration. Now on this date the board of directors they commit to the dividend. So the retained earnings draw downward arrow, it gets reduced and there is a liability created, dividends payable. Then we are looking at the date of highlight record. Now on this date shareholders are identified and those are the shareholders entitled to receive the dividend. But there is no accounting journal entry, highlight no journal entry. Then you have date of highlight payment. Now on this date the dividend declared is distributed to the shareholders as of the record date. So the dividend payable liability is now paid out in cash. So you've got cash, right, paid out. Next we're looking at highlight property dividends. So instead of paying out cash to stockholders, the company is giving out property. Now the property is recorded at fair market value as of the declaration date. So if the fair market value is different from the book value, remember to recognize a gain or a loss on the property. So looking at the example there, Dive company declares dividend in kind of land on 1st December 2011, which is payable on 15th December 2011. The land, which has got a historical cost of $500, is worth $700 on 1st December, the date of declaration, and $750 on 15th December, the date of payment. So we're going to look at the fair value on the date of declaration. So on the date of declaration, first thing, it's retained earnings debit, dividends payable credit. So retained earnings goes down, draw a downward arrow there. Now the land has got a book value of 500, fair value on declaration date 700, $200 gain. So land would be debited by $200 and the credit is to gain on land 200. Now this gain goes to retained earnings. Highlight. So net effect on retained earnings is 500. So in the first journal entry, we had debited retained earnings by 700. Now, due to the gain on land, the retained earnings gets a credit of 200. So the net effect, the net debit to retained earnings is 700 minus 200, that's $500. Moving on to page 21, you have journal entry on the date of payment 15th December. So you have dividend payable, the liability of 700. Now land is paid out, right? Paid out. Next we're looking at highlight liquidating dividends. So these are dividends which are not based on earnings but are a return of capital for which highlight APIC is debited. Do not debit common stock which can be eliminated only on corporate dissolution. So for example, $15,000 dividends paid out with retained earnings balance of $10,000. Note that the $5,000 portion is to be debited to APIC, which is the liquidating dividend. So after you debit $10,000 of retained earnings, the balance in retained earnings is zero. So now there's a return of capital of $5,000 which goes into APIC. Next, highlight scrip dividends. So these are basically issuances of promises to pay in the future and they may bear interest. So therefore they are treated as highlight liability until paid. Now let's talk about highlight stock dividends. So these are not actual distributions of assets or cash from the company and therefore not a liability when declared. Represents highlight only transfer of capital from retained earnings to contributed capital. And that is why the total stockholders' equity that remains unchanged. Also note that highlight recipients of stock dividends, the stockholders, they pass no journal entry. Right there, for stockholders who are receiving the stock dividend, there is number one, no dividend income, and number two, total stock basis remains the same. So they allocate the existing stock basis between the new number of shares that they are holding, but the total basis that remains the same. Now for the company issuing out stock dividends, if it's an ordinary stock dividend, highlight small stock dividends, that's usually less than 20 to 25%, they are recorded at highlight fair market value of the stock. So the debit is to retained earnings, which goes down, downward arrow. The credit is to common stock and APIC common stock. Put a box around that and write stock at fair market value. Okay, the debit is to retained earnings. The credit is to common stock and APIC. Now all these are components of stockholders' equity. So you could say the total stockholders' equity, that's constant. Now look at the next one. Stock splits effected in the form of stock dividends. So that's highlight large stock dividends. So that's usually more than 20 to 25%. That's recorded at highlight stock par value. Now in this case, the debit is to retained earnings. So put a downward arrow for that. And the credit is to common stock. Put a box around the dollar number and write stock at par. So if it's a small stock dividend, you record at fair market value. If it's a large stock dividend, record at par. Next one, highlight stock splits. So in this case, the old stock is exchanged for new stock. It's accounted for by adjusting the par value of the new shares for the split by a memorandum entry. And note that highlight there is no journal entry. Now I want you to put a bracket for stock dividends and stock splits and right there, total stockholders' equity is constant. In case of stock splits, there is no journal entry. In case of stock dividends, we have journal entries, but both the debit and the credit are components of stockholders' equity, such that the total stockholders' equity remains unchanged. Now the board of directors can pay dividends out of retained earnings. Now let us say they want to reserve some portion of this retained earnings from where they cannot pay out dividends. So that would become appropriated retained earnings. Now generally they would want to do that, let's say, to meet some contingent liabilities, to put aside money for those liabilities which are not sure, which are contingent. But when would you do that? Now if you have a probable and estimated contingent liability, you're going to hit your income statement. And naturally, that income will never flow into retained earnings. But what if you have a contingent liabilities which are only reasonably possible or which are probable but not estimable? That's only a required disclosure. You don't hit the income statement. So all income there flows into net income to retained earnings on the balance sheet. So that is when the board may decide to appropriate a portion of those retained earnings. So the portion that they appropriate, they set aside, is called appropriated retained earnings. The portion which is unappropriated, available for dividends, that's unappropriated retained earnings. Now let's also talk about quasi reorganization. Now let's say an entity has a lot of deficit retained earnings here. They got a debit balance in retained earnings. So instead of having income over the years, they've had a lot of losses. Now such a balance sheet would look so stale. But now the company, the entity, they want a fresh start. They want to start again with retained earnings of zero. In that case, they could go for something what we call a quasi reorganization. So in such a quasi reorganization, what the company does is they adjust all their assets to fair market value. And they take out dollars from the APIC And they might even reduce the par value of their common stock. So they're taking out dollars from APIC and common stock, putting it to retained earnings, such that retained earnings is brought up from negative to zero. Quasi reorganization, fresh start. And on the book, we have an example where I've named the company Happy New Year. On page 22, highlight appropriation of retained earnings. Now this is done when highlight portion of retained earnings is appropriated as a reserve to meet certain contingent liabilities that may require large payments in the future. So this makes the appropriated portion of retained earnings highlight unavailable for dividends. However, the total retained earnings that remains unchanged. So you have appropriated and unappropriated, but the total retained earnings is the same. Now this is considered a disclosure on the face of the financials and is highlight appropriate for reasonably possible costs or costs that are probable but not estimable. Now this is not used for probable and estimable losses which are accrued on the income statement and reduce net assets. So you have a journal entry for that where it's loss debit and contingency credit. So the loss reduces net income and reduces the retained earnings on the balance sheet. So there's no need of appropriation here. Only when it's not accrued on the financials that you want to have an appropriation of retained earnings. On the second half of page 22, we are looking at highlight quasi reorganization or fresh start. So in this case, a company with deficit retained earnings tries to eliminate the deficit by highlight reorganizing into a new company. And naturally, this is after obtaining shareholder approval. Now this is an exceptional case where retained earnings, they're increased without any addition of net income. So let's look at the steps via which this is happening. So first one, highlight adjust assets to fair market value. Number two, you want to reduce the par value of stock for that equity and bring APIC credit balance equal to or greater than the retained earnings deficit balance. And then highlight debit APIC as the plug. Now for the next 10 years, the financials must make a disclosure. They must state that a quasi reorganization happened on such a date. Look at the example here. It says Happy New Year company, guys, it's a fresh start, has the following balance sheet accounts. They got assets 700, liabilities 300, common stock 800, APIC 500 and a deficit retained earnings of 900. Now it says the company elects quasi reorganization, assets are reduced to market value of 500 and the par value of the common stock is reduced to $2 from $10 currently. So naturally you have a debit to common stock at $8 per stock calculates to $640. The credit is to assets which have a reduced fair value by 200. Retained earnings deficit needs to be eliminated 900. The plug, the debit plug is to APIC $460. So guys, after the quasi reorganization, retained earnings that has moved up from negative 900 to $0. That was the entire purpose of this quasi reorganization. When we did elements of financial statements way back in FAR-1, we were talking about 10 elements of financial statements. 3 of them, they're right here on the balance sheet. You got assets, liabilities and equity. Within equity, we have 3 more elements. Number 1, investment from owners. So that's the owners investing into the entity. So you got preferred stock, common stock, APIC. Number 2, distribution to owners. So that's the dividends that goes out to preferred stockholders, to common stockholders. And the third element within equity is comprehensive income. Now comprehensive income, that includes net income from the income statement and other comprehensive income from the comprehensive income statement. So guys, on tide N, this is your income statement. OC, this part, this becomes a comprehensive income statement. So you could have a combined statement or 2 separate statements. Now this other comprehensive income here, in the comprehensive income statement, this flows into accumulated OCI on the balance sheet. So you could say accumulated OCI. This represents cumulative changes in stockholders' equity from non-owner transactions other than those which have already gone into retained earnings. So all these are non-owner transactions. Net income flows into retained earnings. Other comprehensive income flows into accumulated other comprehensive income on the balance sheet. Now, we all know the mnemonic for OCI and accumulated OCI, it's PACE. So the P of PACE, that stands for pension adjustments. So you remember all unamortized prior service cost, gains and losses, all that's there in accumulated OCI on the balance sheet. The A of PACE, that stands for unrealized gains or losses on available for sale securities. The moment you sell those securities, that's when you take it out from accumulated OCI, goes into your income statement, flows into retained earnings then. The C of PACE stands for currency translation gains and losses. So we'll talk about that in FAR-6. E of PACE, that stands for effective portion of derivatives held as cash flow hedges. Fair value hedges, income statement. Cash flow hedges, remember, that's accumulated OCI balance sheet. For IFRS, this PACE had an R, it was PACER. So the R under IFRS, that was revaluation surplus if the entity it opts to go for the revaluation model for their PP&E, for their intangibles. So guys, that's about accumulated OCI as part of stockholders' equity on your balance sheet. On page 23, we're looking at accumulated OCI. Now this highlight reflects cumulative changes in net assets resulting from certain transactions not included in net income and not affecting retained earnings. So these go to other comprehensive income on the comprehensive income statement, and from there they flow to the balance sheet into accumulated OCI. Now we know the mnemonic for the components of accumulated OCI is PACE under GAAP. For IFRS, you have an extra R, it becomes PACER. So let's look at other components. The P of PACE, that's pension adjustment, and we have covered this in FAR-4. A stands for available for sale securities, and we are looking at only unrealized gains and losses, and this was in FAR-3. The C of PACE, that's currency translation gains or losses. We have not yet covered this, but we're going to talk about this in FAR-6. The E of PACE, that's effective portion of derivatives held as cash flow hedges. Now, if you don't remember this, you need to get back to FAR-3. And the R, that's only for IFRS, that's revaluation surplus on fixed assets and intangible assets. And that was covered in FAR-4. When we started talking about stockholders' equity today, we started with common stock. And I give you a journal entry for the issuance of common stock when the company, the entity issues common stock to its stockholders. So that's when cash comes in and it's common stock. If it's issued in excess of par, you had APIC. So let's put the journal entry back again. So let's say the company issues common stock. Now let us say the company has issued 10,000 stocks of $10 par at $15 each. So 10,000 stocks into $15, and the par value is $10. So what's the journal entry here? Naturally, cash is coming for the company, so cash is debit. The credit is to common stock, and the excess of par, that goes to APIC common stock. So 10,000 shares at $15 each, that's $150,000 of cash coming in. How much goes to common stock? 10,000 into $10 par, 100,000. In excess of par, that was $5 per share. Into 10,000 gives you $50,000 here. So in that case, you would have the numbers on your balance sheet. So you would have $100,000 for common stock here, and you would have $50,000 for APIC common stock. Now, the company has issued common stock. The company also can go back to the stock market and buy back, shop for its own stock. So it's issued stock here, it can get it back, it can repurchase the stock. Now we talked about the journal entry for repurchase and immediate retirement, but let's say the company goes out, repurchases its stock, not yet retired. So that is something what you call treasury stock. So that's something the company holds in its own treasury. Now there are two perspectives to this. Now if you remember in FAR-3, we talked about investments. So investment was when the company made investment in the another entity's common stock, preferred stock, bonds. Now we could treat treasury stock as the company's investment in its own stock. Now when they invested in somebody else, they wanted dividends, they wanted market capital appreciation. Now when the company is buying back its own stock, it's having its own treasury stock, you could look at the same two perspectives. So if the company buys back its own stock, does it have to pay dividends to that? No, dividends are paid only to outstanding stock, not to the stock held in the company's treasury. Would the company be able to take advantage of market appreciation? Why not? So let's say the company has bought back its stock today. Tomorrow, when the price increases, it can go out to the market and resell the stock. If this is your perspective, you would want to use the cost method to account for treasury stock. So we're looking at treasury stock, the company buying back its own stock, and I'm giving you one method, one perspective, cost method. Now the second perspective could be that, let's say the company, they've got a lot of cash. Now they want to give this cash back to the stockholders, back to the owners of the entity. One good way, that's dividends. So the board of directors declare dividends. Another way of giving cash back to the stockholders is buyback of shares from the owners. So you're giving them cash and asking them, okay, there's a lot of appreciation, give us back. So in this case, generally the company intends to hold those shares indefinitely. They might want to retire them after a point in time. So if this is your perspective, then you would want to use the par value method. So we have the cost method, and the second method for treasury stock would be par value method. Now, before we get going, whenever you're using the cost method for treasury stock, remember cost in, cost out. So you're getting the treasury stock, you're buying, you're investing in them at cost. When you sell them out, you're looking at the cost that you bought them for. In case of the par value method, as the name signifies, par in, so when you're getting the treasury stock, you're accounting for them at par. When they're going out, you're looking at the par value. I know this is a little vague to you right now, but it's going to get very clear the moment we look at the example that we have on our book. Okay, so we are on with the same issuance where the company issues 10,000 common stock at $15, where the par value of each stock is $10. So par is 10. Now we are looking at the company repurchasing 500 shares at $12 each. Look at this, the company had issued stock at $15. Let's say the market price wasn't doing so good. They went out and bought 500 of this 10,000 stock at $12 each. So let us look at the repurchase journal entry. Now guys, here I told you the perspective is as if you've made an investment. So repurchase, and we are looking at 500 into $12. So if you had made an investment in some stock, your journal entry would have been investment debit and cash credit. So the investment would have been for $6,000. Cash went out 6,000. But you haven't made investment in somebody else. You've made an investment in your own stock. So we'll call it treasury stock. Now, the purpose for you to repurchase was to look at market appreciation. You want to resell the stock. So the next journal entry that you're going to look at is resale of the stock that you've repurchased. So you repurchase your own stock from the market, you issued 10,000, bought back 500, now you want to resell this 500 stock. So we're looking at resale journal entries. In the first one, you're reselling 100 shares at 14. Guys, look at it. You bought it back for 12, you're selling it for 14. You're having a gain. Then we're going to look at resell 300 shares at 11. You bought it back for 12 and now you're reselling for only 11. You're having a loss. So let's put these journal entries in place. So we look at repurchase, now we're looking at resell. So if you had bought this investment and you were selling off the investment, you would have cash coming in, investment being credit. So if you had invested in somebody else's stock, and you could have a loss or you could have a gain. Going to grow the similar journal entry. So let's look at both of them. So if you had resold 100 stocks at 14, so 100 into 14. The cash coming in, that would have been 1400. What was your cost of investment? That was 100 into 12. That's what you repurchased it for. So this was 1200. What's the gain? 200. Now, the next one, when you're looking at 300 stocks at 11. What's the cash that's coming in? 300 into 11, 3,300. What's the investment cost of the investment? 300 into 12, that's 3,600. So you have a gain or a loss? You're having a loss of 300 here. Now guys, we are not looking at investment here. We are looking at treasury stock, which you bought, now you're selling it off. So instead of investment, we'll call it treasury stock. Instead of gain and loss, we'll call it epic treasury stock. So the plug, instead of being the gain or the loss, is going to be epic treasury stock. Now generally you don't want to have debit balances in your epic accounts. So yeah, when we sold 100 stocks at 14, we had a $200 gain, a credit going to epic treasury stock for 200. Now in this case, we have a debit of 300 to epic treasury stock. So after these two journal entries, the epic treasury stock would end up having a net debit of 100. We don't want that. So what we'll do instead is, we will debit only 200 to epic treasury stock. So this was 200, debit up 200 here. The remaining 100 will push it to retained earnings. So we could say epic treasury stock plus retained earnings. So guys, as you can understand, you've bought treasury stock here, now you're reselling treasury stock. Your plug is epic treasury stock. And you don't want to have a debit balance, so you would use retained earnings in that case. Now that was your entire purpose. You bought it back, you wanted to resell. Now you bought back 500, you resold 100 here, another 300 here. Now let us say the remaining 100 that you have, you don't want to resell, you want to retire it. Your purpose here was as an investment where you bought stock and you resold it. But you are allowed to retire stock. So you retired, let's say, the remaining 100 stock. So repurchase, resell, retire. So that's the most interesting part about treasury stock. You just need to know the 3 R's: repurchase, resell, retire. So you retire 100 stock. So now that you're retiring the stock, do you still want to have this common stock on your stockholders' equity out here? When you had issued stock, you had common stock, epic common stock. Now that you're retiring, you want to get this off because this common stock is no longer issued and outstanding. So you would want to debit common stock and epic common stock. So if you're retiring the remaining 100 stock, how much had you issued it for? $15 each, of which 10 was par, 5 was in excess of par. So the 100 into 10 that went into common stock, that was 1000. The 100 into 5 that went to APIC common stock, that was 500. So calculates to a $1,500 that you have on the debit. Now the credit, look at this guys, you bought treasury stock. This was a 6,000 at cost. Now when you resold treasury stock, you resold 100 here, so out of 500, 100 gone here. You resold 300 here, so out of 500, 300 gone here. So 6,000 was there in treasury stock, of which 1,200 is gone when you resold, 100 into 12, 300 into 12, 3,600. When you're retiring this 100, again you want to get this treasury stock off because it's no longer there with you, you're retiring it. So the credit would be to treasury stock. Now again the same perspective, you could have a gain or a loss. So you could have a gain on retirement or a loss on retirement. Again think about it. You had issued this stock at $15. What price did you buy it back for? You bought it back for $12. So you'd given something to your stockholders for $15. You bought it back for $12. You've had a gain. But let's say you issued it for $15 and you bought it back for $20. That would have been a loss. So when you're looking at retirement, then you're comparing this price, the price that you paid for it, with your issue price. So now you have a loss. So 1,500 is debit, 1,200 is credit. You had a gain, you've had a gain. So the gain is the remaining $300. So this gain of $300 doesn't go into a gain account, it goes into APIC treasury stock. If you had a loss, again that would have gone into APIC treasury stock. If APIC treasury stock becomes zero, cannot debit it further, you debit retained earnings. So this again is your plug. So guys, simple, easy calculations under cost method. One thing that you want to note out here is whenever you're using treasury stock in your debit or your credit, you're accounting for it at cost. What was your cost of treasury stock here? $12. So when you're buying back 500 stock, 500 into 12, so treasury stock at cost. When you're reselling the treasury stock, you're crediting treasury stock. You're crediting it at cost. 100 into 12. 300 into 12. So this is 500 into 12 gives you 6,000. This is 100 into 12. So your focus is on the 12th number, the cost that you bought it for. This is 300 into 12. When you're retiring it, again you're looking at cost. This was 100 into 12. So guys, that's your perspective. You're always looking at cost in, cost out. The intention that you had was to resell it, but you can of course retire it if you want. So that's all about the cost method. Let's try to compare the same journal entries, the same scenario with the par value method. Now in the par value method, I told you it's par in, par out. So let's have the same issuance where we issued 10,000 stock at $15, $5 in excess of par. Now we are repurchasing the stock at $12 each. So now looking at the par value method. Now the par value method is something like retirement of stock. I mean the journal entry for the repurchase would be something like retirement of stock, because your perspective here is to give back money to the stockholders. You want to buy back your stock and hold it indefinitely. You have not retired it, but you thought you really want to retire them. Now, if you remember the journal entry that I gave to you when we did common stock, so when you repurchase and immediately retire, let's put that journal entry down here. So you had, when we repurchased and immediately retired, you would have debited common stock, APIC common stock. and then you had cash going out, and if you had a gain on retirement, that was APIC retired stock. Remember that? If there was a loss on retirement, you would have APIC retired stock, and the moment APIC retired stock was 0, don't want to debit it further, then you could have used retained earnings. Now, with this perspective here, let's look at repurchase of treasury stock when you're using the par value method. So when you repurchase 500 stock at $12, how much cash is going out? Cash going out is 6,000. That's the same under both the methods. Now, you've repurchased 500 stock. So 500 stock at par, that's 5,000. You issued it for $15 each. So 500 into 5 in excess of par, that's 2,500. So guys, you paid $6,000 for something which you issued for 7,500. You stand to have a gain, a credit plug. So the credit plug here would be 1,500. Now, are you retiring the stock? No. You're holding it with you as treasury stock. Now, your intention may be to retire, but you can still resell them because you've not yet retired them. So instead of using retired stock here, we'll use treasury stock. So instead of calling it APIC retired stock, I'll call it APIC treasury stock. Instead of saying APIC retired stock here, I would say it's APIC treasury stock. So that's my plug here. Now, I don't want to hit common stock because the common stock, that's still issued. It's not yet retired. So I would call it treasury stock, not common stock. So guys, here when we bought back treasury stock, we had treasury stock at cost, $500 into 12. Now here when we've bought back treasury stock, this treasury stock is at par, 500 into 10. Okay, that's why we call this the cost method, and this one is called the par value method because your treasury stock number is always at par value. Now here your intention is to retire. So let us say you retire 100 of this stock. So you bought back 500. Let's first look at the retirement journal entry, then we'll go to resell. Because in cost method, when you repurchase stock, your intention was to resell. Here when you repurchase stock, your general intention is to hold it indefinitely and ultimately retire it. So when you retire 100 stock here, you would credit treasury stock and then you would hit common stock. Your journal entry would be common stock debit and treasury stock credit. So this is repurchase, and here you're looking at retire. Just copying the same thing from there for convenience. Now, treasury stock, that's at par. So when you retire, let's say 100 stock, you repurchased 500 into $12. Now you're retiring 100 stock, then 100 into 10, that gives you $1,000. So that's going off, and common stock is now debited. So guys, now in this case, it was a complicated entry when you repurchased it, but when you retired it, it was simple and easy. Here, it was an easy entry when you repurchased it. When you retired it, it was a little complicated. Now here, in par value method, generally you would want to retire, but as I told you, you could resell. So let's say you decided to resell. Just hope the board is not getting too messy here. So you're looking at repurchase, resell, retire. We're looking at repurchase, resell, retire. As I told you, there are 3 R's when you're accounting for treasury stock. So let's say you've resold 100 stock at 14, 300 stock at 11. Let's go on with the same thing. So when you're reselling, naturally cash is coming in. So when you resold 100 at 14, cash came in $1,400. When you resold 300 at 11, cash came in 3,300. The credit was to treasury stock here at cost. Now here the credit is going to be to treasury stock, but this is the par value method. So treasury stock at par. So what's the par value for 100 stock? So that'd be 100 into 10. What's the par value for 300 stock? 300 into 10. So in this case you would have $1,000 here and you would have $3,000 here. Now look at the plugs that you would require. Here you have $1,400 on the debit, you have $1,000 on the credit. The plug that you would require is $400 on credit here. Now in this case the plug that you would require is $300 on the credit. Now guys, when you had repurchased common stock, we had reversed off the epic common stock that you had on issuance. So let's get that. You have this issuance journal entry where you had epic common stock being credited. The moment you used par value method, you had reversed off this epic common stock. So now that you're reselling common stock that you purchased, reselling the treasury stock, you would again want to have recreate this epic common stock that you reversed. So once again, when you went out, repurchased your common stock under the par value method, you hit epic common stock, you reversed it based on the original issue price. Now that you're reselling this treasury stock, you want to recreate the epic common stock. So you credit epic common stock out here and that's your plug. So guys, understand here. When you repurchased, you reversed epic common stock to the extent of the excess of par at issuance. Now, depending on whether you had a gain or loss, that went to epic treasury stock. Now that you're reselling it, you're recreating the epic common stock that you'd hit out here. You're recreating this epic common stock. The retirement journal entry is simple, easy, good to go. So let's do a quick recap of what's happening here. We're looking at issuance of common stock. That was something we already know. Now we went back to the market, purchased back our own stock, treasury stock. Treasury stock could be accounted for under the cost method or par value method. As the name signify, cost method is cost in, cost out. Par value method is par in, par out. Now, in the cost method, the intention was to buy back, hold it as an investment and resell. In the par value method, the general intention was to buy back and retire. Now the third thing, looking at the plugs. In case of a cost method, you have epic treasury stock as your plug when you're reselling or retiring. In the par value method, you have epic treasury stock when you're repurchasing, and you have epic common stock as your plug when you're reselling. You don't need any plug for retirement because the treasury stock is already at par. Simply need to hit common stock there. The fourth thing, when you hit common stock, epic common stock, under the cost method, you're hitting epic common stock when you're retiring it. In the par value method, you're hitting epic common stock the moment you're repurchasing it. And the last thing, pretty important, is the balance sheet presentation under the cost method and under the par value method. Let's say you've repurchased stock, you've repurchased this stock. Let's forget the reselling and retirement. Let's just look at the repurchase here. So let's go there, put in numbers for repurchase of treasury stock. So back from the duster, yeah. So guys, this was your journal entry on issuance. So when you issued common stock, you had 10,000 stocks into 10, 100,000. 10,000 into 5, 50,000 going into your epic. So let me put it up here. Now, let's say you've used the cost method and you've gone out and you've bought your common stock back. You've bought 500 stock at $12 each. In that case, you're going to have treasury stock at cost. Now, if you're using the cost method for treasury stock, remember, it's going to be a contra stockholders equity. So 100 plus 50, that's total stockholders equity of $150,000. if you get back treasury stock at cost, you're going to do less treasury stock at cost, 6,000. So your net stockholders equity becomes $144,000. That is when you're using the cost method. If you're using the par value method, in that case, what's going to happen? Let's go and look at that. So this was the issuance journal entry. If you use the par value method and you have repurchased stock, you're going to have a hit to Epic common stock, and you will create treasury stock which is at par. You also have a credit to Epic treasury stock. So Epic is debited by 2,500, it's credited by 1,500. So it's Epic common stock, Epic treasury stock. Epic is debited 2,500, Epic is credited 1,500. So you could say the net debit to Epic is $1,000, and you're creating a treasury stock for 5,000. So that's the cash that's going out, 6,000. So now what you would do in that case, let me use a green pen for treasury. You would say common stock less treasury stock at par. And how much was that? You bought back 500 stock into $10 par, 5,000. So this would become 95,000. And your Epic had a net debit of 1,000. So this 50 would have become 49,000. 95 plus 49, that again is 144. So guys, the last number here, the net stockholders equity, that number remains the same whether using the cost method or the par value method. Under the cost method, the treasury stock is contra stockholders equity. Under the par value method, the treasury stock is contra common stock. So generally, let's keep it as the cost method. Let me have the green pen off here. So if it's the cost method, this is 100 plus 50 gives you 150 less 6,000, 144. If it was a par value method, you would have 95 plus 49, 144. So with this, let's go to the book, look at all these journal entries once again, understand the perspectives behind cost method and par value method. Also look at this balance sheet presentation. We're looking at treasury stock on page 24. Right there, common stock or C/S, right, authorized 15,000. So let's say the entity is legally authorized to issue 15,000 common stock. Right, issued 10,000. So let's say the entity has actually issued 10,000 of the 15,000 common stock it was authorized to issue. Right, outstanding 9,500. So this is the issued stock which is in the hand of the shareholders. The difference between issued and outstanding, right, 500 treasury stock. There are two methods to account for treasury stock. The first one we're looking at, put a box around, cost method. So in this method, you account for treasury stock at repurchase circle cost. And it's generally used if the company highlight intends to resell the share. So look at this, when the company repurchases share, the debit is to treasury stock, right, at cost, at the repurchase cost. And right there, treat like investment in own stock. When the company is reselling the treasury stock, that's like selling the investment, where the plug is to Epic treasury stock. So for the reselling journal entries, draw a bracket and write sell the investment. Moving on to page 25, when you retire treasury stock, the debit is to common stock at issue price. So you debit common stock as well as Epic common stock. So put a box around the two numbers and write issue price and highlight Epic common stock. The credit that's to treasury stock, right, at cost. Guys, this is the cost method. The treasury stock number is always at cost. The plug, that's to APIC treasury stock. So when we're trying to analyze the accounting treatment, circle plugs. Under the cost method, when you resell treasury stock, the plug is highlight APIC treasury stock. When you're retiring, even then the plug is highlight APIC treasury stock. The next question is, when do we debit APIC common stock? That's debited at retirement. Until then, treasury stock is at cost or the repurchase price. Let's go back to page 24 where we're looking at the second method to account for treasury stock. Put a box around par value method. Now in this method we account for treasury stock at circle par value. Now this is generally used if the company highlight intends to hold shares indefinitely. So when the company repurchases stock, the debit, that's to treasury stock, right, at par. But then you want to debit the entire issue price. So put a box around 5,000 and 2,500 and write issue price. Treasury stock, that's taken at par. The balance goes to highlight APIC common stock. The plug on the credit or the debit is to APIC treasury stock. So guys, what we're doing is we are treating it like, right, retirement of stock. Now if you resell treasury stock under the par value method, put a bracket and write like new stock issued. So when you're reselling the shares, treasury stock is credited at par. The plug, that's to APIC common stock, because APIC common stock had been debited when you repurchased the stock. Back on page 25, when you retire treasury stock under the par value method, debit common stock and you credit treasury stock, right, at par. And that's a pretty simple journal entry, because guys, if you realize, we generally use par value method when the intent is to hold them indefinitely and retire them. Now looking at the analysis of accounting treatment, circle plugs. In case of repurchase under the par value method, the plug is highlight APIC treasury stock. When you're reselling, in that case the plug is highlight APIC common stock, because APIC common stock was debited, was closed off when you repurchased the stock under the par value method. On the second half of page 25, we got the balance sheet presentation of treasury stock accounted for under the cost method and the par value method. So under cost method, you have all the components of stockholders' equity, and at the end you do less treasury stock at cost, and right there, contra stockholders' equity. Whereas under the par value method, where you have common stock at par, that is where you do less treasury stock at par. So this number acts as, right, contra common stock. But under both the methods, the total stockholders equity number, that remains the same. So in this example, it's $144,000 in each case. Now one more thing that we need to note here is under IFRS, you not only have these two options of cost method or par value method, you have a third option called the constructive retirement method, which is not allowed under US GAAP. Now this constructive retirement method is similar to the par value method, except that the par value of the reacquired shares are charged to common stock account instead of the treasury stock account. Now this method is used when the management does not intend to reissue the shares, or the jurisdiction of incorporation requires that reacquired shares be retired. When you're looking at common stock, we're looking at three numbers for common stock. What's the authorized number of common stock? what's the issued number, and how much is outstanding. So for common stock, we're talking about authorized, issued, and outstanding. So let us say this corporation out here, they had authorized common stock. That means the number of common stock they are legally authorized to issue as per their charter. So they are authorized of 15,000 common stock. How much did they actually issue? They issued 10,000 here. So they were allowed to issue 15,000. They didn't issue all of that. They issued only 10,000. So issued is 10,000. Now of the 10,000 they issued, they went out and they bought back, let's say 500. They repurchased 500 of their common stock, which became treasury stock. So how much is outstanding? So that issued 10,000, bought back 500. Outstanding is 9,500. This 500 difference between issued and outstanding, that's the treasury stock 500. Now this treasury stock the company has could be accounted for using the cost method or the par value method, and that's all I have all over my board around here. Now I know you guys are experts in accounting for treasury stock, but let me do a quick recap. So if you're using the cost method to account for treasury stock, it's cost in, when you repurchase it's at cost, and cost out whether you're reselling or retiring. So debit here, credit here. When you're using the par value method, it's par in, debit here, and par out when you're reselling or retiring, credit. Now, when you're using cost method, generally you have an intention to resell the treasury stock. When you're using the par value method, generally the intention is to retire the treasury stock. Now, looking at the plugs, when you're using cost method, the plug is APIC treasury stock when you're reselling or retiring. When you're using the par value method, the plug is APIC treasury stock the moment you repurchase it, and if you resell, your plug is APIC common stock because you have hit APIC common stock the moment you repurchased. It's sort of like retirement of stock entry. So now when you're reselling it, you recreate APIC common stock. In the cost method, you don't hit APIC common stock here. You hit APIC common stock only when you actually retire it. And the balance sheet presentation, we saw that. So if it was treasury stock at cost, that was contra stockholders equity. If it was treasury stock at par, then that was contra common stock. Now, when you're talking about common stock, what's market value of common stock? You could go out, look it up on the stock exchange, the market value, the price at which the stocks are trading. Now, if somebody asks you, use CPAs to calculate the book value of common stock, how do you do that? So in that case, what you do is you take stockholders' equity. Now, on your stockholders' equity, you've already adjusted for treasury stock. If it's at cost, you've adjusted it here. If it's at par, you would have adjusted it here. So you take your net stockholders' equity here, and from this, you also take off preferred stock. Because guys, I'm asking you for the book value of common stock. So from this number here, you take off preferred stock. So that gives you the numerator, the common stockholders equity on the balance sheet. Because guys, this number, this is for the preferred stockholders. Everything else is for the common stockholders. So that gives you the numerator for calculating book value of common stock, which is common stockholders equity on the balance sheet. This is total stockholders equity. The moment you take off preferred stock, it becomes common stockholders equity. Your denominator would be the number of common stock outstanding. Understand, we've already taken out the treasury stock either here or here. So when our numerator is already adjusted for the treasury stock, even our denominator needs to be adjusted for treasury stock. It needs to be the number of common stock outstanding. So if you're asked to calculate the book value of common stock, the numerator is common stockholders equity on the balance sheet. The denominator is the number of common stock outstanding. The second bullet on page 26, we're looking at authorized, issued, and outstanding stock. And right there, treasury stock or T/S equals issued minus outstanding. And towards the bottom of this page, we have the formula for highlight book value per common stock. The numerator, that's highlight common stockholders' equity, that's on balance sheet. The denominator, highlight number of common stock outstanding. We've been talking so much about stockholders of the entity, the owners of the entity. So let's look at the corporate structure. So we have the stockholders, or the owners of the entity. Now they don't run the company. They appoint the board of directors, who then hire the management to run the company on behalf of the stockholders. That's how the corporate cycle runs. And that's why it's so important to have the right kind of corporate governance in place to make sure that the interests of the management that's aligned with that of the stockholders. Now, the board of directors, they also are responsible for paying out dividends to stockholders. So we saw dividends here. The board decides, the board declares the dividends to be paid out to stockholders. The board of directors, they decide whether to go out to the market and buy back the company's stock. That becomes treasury stock. Now I said dividends, treasury stock, good ways of giving back money back to the owners, back to the stockholders who are owning the company. Looking at the management and the stockholders. Management, they're supposed to act as agents of the stockholders, act in their best interest, increase the company's wealth, increase the company's stock price. Now, what if the management is not doing a good job? The stockholders will tell the board of directors to fire the management, get a new management in place. But that's an extreme step. In the interim, let's try to incentivize these guys, incentivize the management so that their interests are aligned with that of the stockholders, so that they work hard in increasing the company's value, increasing the company's wealth, increasing the company's stock price. So that's why you often give share-based payments, stock price-based payments to the management, to the employees of the company. And these share-based payments could be in the form of equity or liability. So let's say when you issue employee stock options, ESOPs, that's like share-based payments to the management, to the employees, which are accounted for as equity. If you give these guys stock appreciation rights, so if the stock appreciates, they get paid. That becomes a share-based payment which is accounted for as a liability. So let's talk about share-based payments which are given to the employees of the company, to the management, to make sure they work real hard in the best interest of the stockholders. So we're looking at share-based payments. And it could be accounted for as equity or as a liability. So let's say ESOPs, stock options, they are accounted for as equity. Now, there could be stock appreciation rights. They could be accounted for as a liability. Now, both these share-based payments, they are accounted for at fair value. So this is measured at fair value. This one is also measured at fair value. So this is fair value of the option, this is fair value of the liability. But this measurement happens at grant date. The date the stock options are granted. This measurement happens at settlement or exercise date. Now, you also need to have this measurement at the end of each reporting period, because when you're reporting your financials, you need to have this liability number in place. And at the end of each reporting period. Let's first talk about stock options. Now, when we're looking at stock options, they could be compensatory or non-compensatory. So a non-compensatory stock options is like a widely issued stock option to everybody. So you can come and exercise the stock option, take home common stock. Now, if you remember, we talked about stock rights when we were doing APEC. Stock rights are stock options which are granted to the stockholders of the entity. So before new stocks are being issued, you grant stock rights to the stockholders so that they have a preemptive right, so that their stake is not diluted. If they have a stock right, they can exercise it and increase their stake to ensure that they don't dilute their stake. Now that was a stock right which we said no journal entry is required, because only when the stockholders exercised the stock right did we have a journal entry, and that journal entry would be similar to the journal entry that we have on issuance of common stock. Same rule applies to non-compensatory stock options. Stock options not issued for compensation purposes. So in that case, when the stock option is granted, there is no journal entry. Only when the stock option is exercised that we have a journal entry where the common stock is being issued and some cash is coming in. So this journal entry is similar to when you issue common stock in exchange for cash. But here our focus is share-based payments to employees, and we are looking at compensatory stock options. The intention is to provide a benefit to the employees, to the management, so that they act in the best interest of the stockholders. Now, measured at fair value. How do you measure the fair value? I'm going to talk about a couple of techniques here. Black-Scholes model. The name itself sounds so tough. In reality, it's pretty tough, and it's outside the scope of the CPA exams. So we don't need to worry about how this model works, but we know this model helps us calculate the fair value of the stock options. You could also use the binomial distribution model. Now understand the logic behind the fair value of stock options. Let us say the company's stock is trading at a particular price, let's say $34, and we grant a compensatory stock option to the employees such that they can exercise the option and take home the company stock at $34. Stock is trading at $34. They can go to the market and buy it for $34. Why would they exercise it? So the intrinsic value of the stock option is 0, because the current selling price 34. They can exercise it at 34. No point, nobody would do that. What if the stock price falls, goes below 34? It's out of the money. They'll never exercise it. But there is also a probability that the stock price would go up. And in that case, let's say it's $34 now, the stock price goes up to $50. In that case, the employee can still exercise the stock option at $34. So he'll make a good gain of $16 here. So guys, there is a probability that the stock option will not be exercised if the stock price is at or below the option strike price. But if the stock price is above the option strike price, such that the option is in the money, then there is a probability that this option will be exercised. And then you can have a range of probabilities. So you could have a probability where the stock price is 40, if it's 45, if it's 50. So these models use that probability. So especially the binomial distribution model, it's based on expected cash flows in the future. So based on the probabilities, you're going to assign a fair value to the stock option right now on the grant date. So stock is trading at $34. Option strike price $34. Intrinsic value 0. But the fair value is something, because there is a probability that the stock price would go up. And this option provides the employee with the right but not the obligation to exercise the option. So guys, with that, let's look at an example on the book. And before we go on further, one more thing that I want to point out about stock options is vesting period. Another question that you have is, how long does the employee need to work, need to put in the hours before he can exercise the stock option, take home the company stock, make a gain if the stock price is above the option strike price? How long does he have to work? So let's say the vesting period, or he needs to work for 2 years before he can exercise the stock option. So that means that the option fair value is the employee's compensation for his next 2 years of service, for the vesting period of the stock option. Let's look at the example, and we have all that I said right here on this example. So it says, assume a company has granted an employee one option on 1st Jan 2011. giving the employee the right to buy one share. Guys, it's the right, not the obligation, right to buy one share of the company's $10 par common stock for $34, its current selling price. The option can be exercised after 1st Jan 2013. We are granting it right now, 1st Jan 2011, but he can exercise it only after 2 years. If the employee remains in service to the company. So guys, we're making sure he keeps working for the company. And the option, it expires on 31st December 2013. So it's open for 1 year. The company is using the fair value method, and the value at 1st Jan 2011 using the binomial distribution model is estimated at $6 per option. Guys, stock is trading at $34. Option strike price, that's also $34. Though the intrinsic value looks zero, there is a probability that the stock price will rise, and that's why this stock option has some fair value as of grant date, and that is $6. But we are not giving it to the employee right away. We are telling him, we are giving you the stock option which you can exercise only after 2 years, provided you work for us for the next 2 years. So it's compensation expense which is going to be expensed on the income statement over the next 2 years, not right now. So that is why what we would do is, on the grant date, we'll have to pass the journal entry which looks like EPIC deferred compensation. It's not compensation right now, it's deferred on the next 2 years. And the credit naturally would be EPIC stock options outstanding. So we said the fair value as of grant date was $6. It's never $6, it's $6 million. So you have $6 million here. Now look at this. EPIC stock options outstanding. We are comfortable with that. So that basically increases the stockholders' equity. EPIC deferred compensation. Now I've been telling you we don't want debits on EPIC accounts. EPIC deferred compensation, that's a negative to EPIC. So what we do is, when we're presenting the balance sheet, we're going to have EPIC stock options outstanding $6 million less EPIC deferred compensation. So EPIC deferred compensation would act as a contra to EPIC stock options. So 6 minus 6, it's 0. There's no change to stockholders' equity, no change anywhere. It's just an entry which shows that there has been a stock option which is granted to an employee. But as the employee puts in the hours over the next 2 years, that becomes compensation expense which needs to go to the income statement. So over the vesting period or the service period over the next 2 years, required service period. So service or vesting period, we're going to have compensation expense, or you could call it salary. It's part of your salary expense, compensation. And that is when we reduce this EPIC, or rather it's a debit now, we take it off. We reverse the EPIC deferred compensation. So let's say at the end of year 1, it's 2 years of service required. So at the end of year 1, we would say the compensation expense is half of this, because 2 years, 3 million. Next year it's going to be another 3 million. And both the years we're going to reverse this deferred compensation by 3 and 3. So guys, what's happening? Let's look at it. So we had EPIC stock options outstanding, which remains at 6 million. The EPIC deferred compensation at the end of year 1, that becomes 3. 6 minus 3, then you have 3 here, and 3 goes as a salary expense here. Year 2, so that was year 1. So year 1 you have 3 coming here. Year 2, you have another 3 of compensation expense here, and that is when EPIC deferred compensation becomes 0. So stock options outstanding is all this $6 million. Now after 2 years, the employee can either exercise this stock option. He would exercise it if it is in the money, if the stock price is more than the option strike price, or he would let it expire if he did a bad job and the stock price actually reduced. He'll never exercise it. So that could be expired stock options. So let's look at both the cases, whether he exercises it or he lets it expire. So generally the employee would exercise the stock option if it's in the money. In that case, what happens? Is this stock option outstanding anymore? If it's exercised, it's no longer outstanding. So we need to reverse this. So our debit would be APIC stock option outstanding. And that is for $6 million. So guys, APIC deferred compensation. Now this got reversed here. So after 2 years, this was a wash. Now APIC stock options outstanding, that is getting reversed here. Now the exercise price, the option strike price, that's 34 million or $34. So the employee needs to get in cash 34. And then he would be taking home the company's common stock, which is at $10 par. So common stock credit 10. The balance plug, that would go to APIC common stock. That's 30. So guys, simple and easy. Now remember when we had issued common stock for cash, the journal entry was cash debit, common stock credit, APIC common stock credit. So APIC common stock was credited in excess of par. So let us say if this stock, instead of being issued as an exercise of an option, it was issued out for cash $40. So that would have been cash 40, common stock 10, APIC common stock 30. But now in this case, cash coming in is only 34. There's some APIC stock options outstanding 6. So that's exactly what's happening there. So we already know issuance for cash. Now we are looking at exercise of the stock option. Now I said if the stock option is out of the money, the stock options could even get expired. So let's look at expiry of stock options here. So this is exercise or expire, either of the two E's. Now if the stock option expires, is it still outstanding? No. If it's expired, it's no longer outstanding. So you would debit, you would reverse APIC stock options. The way you did it here, same thing. APIC stock option outstanding for 6 million. And now the credit would be APIC expired stock option or APIC stock option expired. So it's something like the company had issued out the stock options to the employee, but on the date of the exercise or the period of exercise, the option was out of the money. And naturally the employee did not exercise it, it got expired. So that is when the 6 million which was lying here in stock option outstanding, what it did was you simply transferred it to stock option expired. So this 6 million which was there in stock option outstanding, you rubbed it from here and you put it in expired. So that's the end of story, not exercised. So guys, as you can understand, we've looked at share-based payment classified as equity, focuses on stock options. Here we look at compensatory stock options. You're going to measure it at fair value on the grant date, the date the stock option is granted to the employee. So that's your journal entry here. You have a stock option outstanding, the debit is to deferred compensation, which is expensed. This goes to the income statement, which is expensed over the required service period or the vesting period. Then finally, when the option is exercised or expires, you reverse off the stock option outstanding because it's no longer outstanding now. If it's exercised, some cash comes into the entity issues common stock. If it's expired, you simply park it into stock option expired, APIC stock option expired. So that was about stock options. Now besides stock options, you could also issue stock appreciation rights to employees. So that is basically measured at fair value again, but fair value of the liability, and it's measured at settlement or exercise date. And you're also looking at measurement at the end of each reporting period. So again, we look at another example on the book. So it says, assume the client has given its president 100 stock appreciation rights on 1st Jan 2011, exercisable immediately and expiring on 31st December 2015. The stock price on various dates were as follows. So when the stock appreciation right was given, the stock price was $20. So if the stock price appreciated over $20, all the appreciation would be payable to the president, and that appreciation would be multiplied by 100 because he's got 100 stock appreciation rights. Now on the date of the grant, stock price is 20. Only when it goes above 20 would the president be getting something. So there's no entry there. But at the end of the first reporting period, at the end of year 1, that is when you're looking at what's the liability for the stock appreciation right. So you could say on the grant date, there's no journal entry. Now we are looking at, let's say, at the end of each reporting period, so at the end of each reporting period, we are again going to have a compensation expense, compensation or salary. Now here the credit was APIC deferred compensation because we had created this APIC deferred compensation with a debit balance on the grant date. Here the credit is to a liability because the company would have a liability to pay to the president if the president exercised the stock appreciation right. So it is a liability for the stock appreciation rate. Now it says in the first year the stock increased $3. So at the end of year 1 it was $23, not 20. So that's an appreciation of $3 per stock. And the president, he had 100 of those stock appreciation rights. So the liability of the company at the end of year 1 was $300. So that was the compensation expense for the period. Now, if I look at the second year, at the end of second year, the stock price had gone up to 28. So the liability of the company was now not $3 but $8. Now they already had a liability for $3. They needed to have a liability for the remaining $5. That would have been 500 at the end of year 2. And let's say at this point, the president exercises his stock appreciation right. So basically, he'll be taking home cash $800 because the stock price at the end of year 2 is $28, $8 above the price when the stock appreciation right was granted. So that's an $800 take home for him. So that would be basically the settlement or exercise. So the liability would be debited because it's no longer a liability as the president has taken home the cash. So cash is credit. So that's at the end of year 2. So that's 800 and 800. So the liability which was created is now being reversed as the president takes home the cash based on his stock appreciation right. Now in this case what we had was, in this example, we had no vesting period required of the president. So he could exercise it even after year 1. If he exercised the stock appreciation right after year 1, he would have taken home $300, but he decided to wait for another year. And at the end of year 2, when the stock price went to $28, $8 appreciation, he exercised it. If there was a vesting period required, if we said, Mr. President, you cannot exercise the stock appreciation right for the next 2 years. So you got to work for at least 2 years for the company before you can exercise it. That would have been a vesting period. In that case, what we would have done is, instead of having a $300 expense in year 1, we would just have half of it, $150 in year 1. And if it was exercisable at the end of year 2, then this 500 would have become 500 plus 150, 650. So it would have become 800 in total, and the president could have exercised and taken home $800 in cash. So not so complicated on the CPA exams, pretty much simple, pretty much basic, and I'm pretty sure you're comfortable with the share-based payments that I've just taught you. Looking at it once again very quickly. Share-based payment could be classified as equity or liability. Looking at stock options here, compensatory stock options, looking at stock appreciation rights. Fair value at grant date, fair value at settlement or exercise date. Also need to make sure you have the liability at each reporting period. On the grant date, you're creating an epic deferred compensation and you have stock options outstanding. Epic deferred compensation is reversed over the service period. Epic stock options outstanding, that's reversed either when the option is exercised or when the option expires. Now, in this case, at the end of each reporting period, you're having a compensation expense creating a liability, and naturally that liability is paid out for cash when the employee exercises the stock appreciation right. Now, on page 27, we're looking at share-based payments generally to employees. Now, they may be considered equity or liability. So, right there, equity equals stock options. Liability equals stock appreciation right. And highlight equity, measure at the fair value of the securities where the measurement date is the grant date of the stock options. In case of a liability, it's measured at the fair value of the liability incurred and the measurement date is the settlement or the exercise date. First, let's look at highlight stock options. Now, stock options could also be highlight non-compensatory. Now, non-compensatory stock options means right no benefit today. And for such stock options, there is highlight no entry on the books. Only when the option is exercised and the company issues common stock, that's when an entry is passed by the company. But we're going to focus on highlight compensatory stock options, which are right meant to compensate. Now, the compensation expense reported by the company is based on highlight estimated fair value of the options when granted. And we know such stock options are share-based payments classified as highlight equity and highlight measurement date equals grant date. Turn on to page 28. Now, to measure the fair value of the options on the grant date, we could use highlight option pricing models. A very good model is highlight Black-Scholes model. We could also use highlight binomial distribution model, which is based on expected cash flows. Now, moving down on this page, we're looking at highlight vesting period. That's the period over which the employee is required to provide services. So it could be highlight cliff vesting schedule where all the options vest at once. It could also be highlight graded vesting schedule where options vest in piecemeal. Now we're going to talk about highlight recording stock options and make a note there, use fair value on option grant date. Move on to page 29 where we're looking at the journal entries for recording stock options. Beside the first journal entry, right, option granted to employee. Now in this case, the debit is underlined epic deferred compensation and put a box around epic stock options outstanding, which is the credit. And for this journal entry, we're going to use right at fair value on option grant date. Because this is a share-based payment classified as equity, we're going to use fair value at grant date. Now, since the employee must remain for 2 years before the option can be exercised, the compensation expense is allocated over those 2 years. So highlight compensation expense, right, I/S because that goes to the income statement, and right, recognize over required service period. And the credit is to underline epic deferred compensation. So the APIC deferred compensation, which is recognized in the first journal entry, is now reversed off over the required service period of the employee. Now, in the first journal entry where the option was granted to employee, we also had APIC stock options outstanding. Now, that is reversed off when either the employee exercises the option or the options expire. So, let's look at the journal entry if the employee exercises the option. On the debit, I want you to put a box around APIC stock options outstanding and write employee exercises option. So when the employee exercises the option, cash comes into the company, APIC stock options outstanding is debited and common stock is issued. The plug is APIC common stock. However, on the other hand, if the employee lets the options expire, then again we have put a box around APIC stock options outstanding and write option expires. Now, in this case, we have APIC expired stock options on the credit. On page 30, we're looking at highlight stock appreciation right. Now, this is a share-based payment classified as highlight liability. And therefore, highlight measurement date equals settlement or exercise date. So, looking at our journal entries, the first journal entry in year 1, that was highlight compensation expense, which went to write I/S income statement, and the credit was to put a box around liability. In the second year again, because the liability increased, the debit was to highlight compensation expense, which went to I/S income statement, and the credit was to put a box around liability. The moment the employee exercises the rights and receives the payment, liability is debited and cash goes out. Looking at the entity's balance sheet, on that side of the balance sheet, we got assets. So these are rights of the entity. Now on this side, we got liabilities and stockholders' equity. Now, what's the difference between liabilities and equity? Now liabilities, these are obligations of the entity. Equity, no obligation here. So let's say the company's borrowed some money, they've taken in debt. They've got an obligation to make interest payments. They have an obligation to repay the debt. Now if they've taken in equity, there's no obligation to pay out dividends. Only if the company, the entity has made enough money, if they have retained earnings, they can give out dividends. Let's say the entity is liquidating, they're dissolving the corporation. Now, all the assets, all the cash that they get here is first used to repay the liabilities, because that's an obligation of the entity. After the obligations are cleared, if there's some excess funds remaining, that goes on to the owners, the equity holders. So guys, liability, obligation. Stockholders' equity, not an obligation. But let us say the company, the corporation has issued some stockholder equity and the corporation has an unconditional obligation to repay the equity. Now in that case, the moment there's obligation, it's not equity anymore. It becomes a liability, it becomes debt. Now in such a case, you want to classify these equity securities as debt, as liability, because though it's equity in form, it's actually debt in substance. So guys, we talked about mandatorily redeemable preference stock. So the moment you have equity stock mandatorily redeemable, there's an unconditional obligation to the entity. It's equity in form, debt in substance. On page 31, we're looking at equity securities classified as debt. So these are equity in form but debt in substance. Now generally this happens when there is unconditional obligation for the corporation to redeem the shares either at a specific date or upon the occurrence of an event that is certain to occur. And generally, that event is the death of the owner of the securities. Now, come down towards the bottom of this page and look at the example there. It says Secret 7 Corp is formed by 7 friends and a single class of common stock is issued. There is a provision requiring the corporation to repurchase the shares of any shareholder who dies by the payment of cash equal to the net book value of the shares on the latest financial statement prior to the death. In such a circumstance, the common stock is treated as a liability. So the balance sheet may appear as follows. So they got assets, they have liabilities other than shares, and as part of liabilities they also have shares subject to mandatory redemption. So guys, notice that there is no equity section. So the common stock, APIC, retained earnings related to the shares, they would be merely disclosed as a note to the financials. On the balance sheet, they'll have only assets and liabilities, no equity. Now that we know all about accounting for stockholders' equity, let's quickly look at the presentation of stockholders' equity on the balance sheet. So you got a few categories here. So you got preferred stock, you got common stock, you got APIC, additional paid-in capital. APIC could be due to preferred stock, common stock, retired stock, treasury stock, APIC warrants, APIC stock options outstanding, stock options expired. Then you could also have non-controlling interest if consolidated financials are prepared. So let's say Walmart, they've got consolidated financials, they've got a lot of subsidiaries. So the non-controlling interest represents the portion of net assets of the subsidiaries that is not owned by the parent, not owned by the consolidated entity. That portion which is owned by non-controlling guys, the minorities. So we'll talk about this in detail when we get to FAR-6. Hold on to your seats, it's yet to come. So we looked at preferred stock, common stock, APIC, non-controlling interest. Fifth, retained earnings, accumulated OCI. We looked at treasury stock. So you could say basically stockholders' equity has got these 7 categories. Now one thing that you need to be really careful about is required disclosures for components of stockholders' equity on the face of the balance sheet. So if you have the balance sheet here, what are the disclosures required on the face of the balance sheet? So if it's preferred stock, on the face of the balance sheet, you need to talk about what's the par value of this preferred stock. What's the dividend preference rate? Is it 7% preferred stock or is it 10% preferred stock? If the preferred stock is cumulative or participating, you got to indicate that here. You got to talk about the number of preferred stock authorized, issued and outstanding. Now for common stock, you again have required disclosures on the face of the balance sheet. So you got to disclose the par value of the common stock and you got to talk about the number of common stock authorized, issued and outstanding. Let's say you got treasury stock. You got to talk about the number of treasury stock that the company has in its treasury, that it's bought back from the market, not yet retired. And then you got to indicate, let's say you're doing treasury stock at cost, you got to indicate that you're following the cost method. If you're doing it at par, indicate that you are following the par value method. So these are important required disclosures which are not in the notes but they're on the face of the balance sheet. On page 32, we're looking at presentation of stockholders' equity and circle on balance sheet. So balance sheet contains assets equals liabilities plus equity. And now we're focusing on the equity section of the balance sheet. We're looking at highlight capital stock, and that could be highlight preferred stock and common stock. Now if it's common stock subscribed, not yet fully paid up, that would be separate. So underline common stock subscribed. Now though we have common stock subscribed at par value, there is underline less subscription receivable. After capital stock, you have highlight additional paid-in capital, APIC. Now it could be APIC preferred stock, APIC common stock or retired stock, APIC treasury stock, APIC warrants, APIC stock options, APIC expired stock options. And then we would have highlight non-controlling interest in subsidiaries. Now non-controlling interest comes in when there is consolidation, and write cover in FAR-6. Next, highlight retained earnings. So you have beginning retained earnings plus any adjustments becomes adjusted beginning retained earnings plus net income minus dividends gives you ending retained earnings. Now here retained earnings could be appropriated or they could be free and unappropriated, so that you could pay out dividends from that portion. Next we have highlight accumulated other comprehensive income. So that's the cumulative number for the other comprehensive income number that we have every year on the comprehensive income statement. This gets us to highlight total stockholders' equity. Now if you have treasury stock accounted for under the cost method, that's a subtract. So highlight less treasury stock only if under cost method, because in that case the treasury stock number becomes right contra stockholders equity. I want you to turn to page 34 and look at the second bullet, retained earnings, where we have highlight statement of retained earnings. Now this statement could be presented as part of the disclosures. So look at it, we have beginning retained earnings plus prior period adjustments. Now these are retrospective adjustments which could be due to changes in accounting principle or due to error corrections. That gives us adjusted beginning retained earnings. Then you have add net income for the year less dividends paid out during the year gives you ending retained earnings. I'm sure all of you here recall the 5 financial statements I gave to you in FAR-1. We had number 1, the balance sheet. Number 2, the income statement. Number 3 was the statement of comprehensive income. Number 4 was statement of changes in stockholders' equity. How these numbers have changed from the beginning of the year to the end of the year numbers that's come on the balance sheet. And number 5 was the statement of cash flows, how cash has changed from the beginning of the year to the end of the year. Now US GAAP requires that this statement of changes in stockholders' equity be presented either as a primary financial statement or in the notes to the financials. But SEC requires that for issuers for public companies, this statement of changes in stockholders' equity, this be presented as a primary financial statement. Now, even IFRS has the same requirement, present the statement of changes in stockholders' equity as a primary financial statement. So guys, once again, we are looking at 5 financial statements. Number 1, we're looking at balance sheet. Number 2, we got the income statement. Number 3, we got the statement of comprehensive income, and we talked about all these 3 in FAR-1. Now in this section of FAR-5, we've talked about statement of changes in stockholders' equity. When we get towards the end of FAR-5, the last section, we're going to talk about the statement of cash flows, where we're going to talk about operating activities, investing activities, financing activities. So guys, as you can understand, you guys are becoming experts in all these 5 financial statements, and I'm sure you're having a lot of fun out here. On page 35, we're talking about the statement of changes in stockholders' equity. Now highlight, under US GAAP, statement of changes in stockholders' equity may be presented as a primary financial statement or in the notes to the financials. However, SEC requires its presentation as primary financial statements. So that's for issuers, public companies. Also highlight, under IFRS, as with the SEC, the statement of changes in stockholders' equity is presented as a primary financial statement.